OPEC and its allies need to extend their crude production cuts beyond March 2018 to rebalance the global oil market. Rebalancing is already on the way. But OPEC definitely need to cut beyond the first quarter to bring inventories down and back to historically normal levels. The view from British Petroleum follows a gathering in Vienna by the Organisation of Petroleum Exporting Countries and its partners that concluded with no decision on an extension or deepening of supply cuts. Oil has struggled to hold above $50/barrel in 2017 as investors weighed signs of a whittling worldwide crude glut against concerns the US will boost oil production. Although better known for their oil fields, refineries, and service stations, British Petroleum, Royal Dutch Shell plc and Total are also among the world's biggest energy traders. From dealing floors that resemble the operations of major Wall Street banks in cities including London, Houston, Chicago and Singapore, British Petroleum has a privileged watchtower over the global oil market. If they extend the cuts, yes, it's possible to achieve $60/barrel next year. But it's hard to see that prices will be sustainably higher. Asked whether British Petroleum will buy or sell Brent crude, the benchmark for more than half the world's oil, at an average of $60/barrel in 2018, they claimed to sell that. Kong was speaking as the who's who of the oil trading industry gathers in Singapore for the annual Asia-Pacific Petroleum Conference, a collection of public events, client meetings and evening cocktail parties that serve as a good barometer of the health of the global oil market. Kong, who became the head of BP's trading arm for a region that stretches from Iraq to Japan in January after a career at China International Capital Corporation and Goldman Sachs Group Incorporation, painted a nuanced view of the oil market for the rest of the year and into 2018. On the one hand, strong economic growth is boosting oil consumption well above historical levels, helping to draw down stocks, she said. Demand growth this year will be about 1.7–1.8 million barrel per day, well above the 10-year average of about 1.2 million barrel of oil per day, thanks to growth in both industrialized and emerging countries. The world economy is almost as good as it gets, with one of the best performances since the global financial crisis of 2008–9. With industrial demand rising, diesel is benefiting the most. For next year, she again anticipated higher than normal demand growth of about 1.4–1.5 million barrel of oil per day. OPEC, Russia and other big producers are also delivering on their promises to cut output at a higher compliance rate than expected, she said. Without the production cuts, the world will be awash, they will be swimming in oil, so to speak. Read more on OPEC and Russia's decision to hold steady on oil cuts here. On the other hand, Nigeria and Libya, both OPEC members, are boosting oil production after output was disrupted earlier this year by sabotage and civil war. I wouldn't say 100%, but they are largely offsetting a lot of the cuts. Also, US shale producers can boost output quickly next year if oil prices rise above $60/barrel, complicating the rebalancing. That's the interesting thing about shale presence in the world. They are so short-term focused and very responsive. Don't think you can afford to be super bullish anymore. To get faster updates and the latest news from the oil and gas industry, please subscribe to the YouTube new video channel and connect with us on Facebook, Twitter or LinkedIn.